Welcome back. Now, according to the Reserve Bank data, at the end of last year, the banking sector had just over 5 trillion rand in advances and nearly 6 trillion rand in deposits. On both fronts, Standard Bank dominates, holding the lion's share of the 11 trillion rand industry. Banking analyst from Denker Capital, Kokkie Kooyman, joins us with his analysis of Standard Bank, greater perspective on the sector at large. Kokkie, an absolute pleasure. Good afternoon to you.
Yeah, no, thank you very much for having me on the show.
Well, Kokkie, 11 trillion rand, that is quite an amount. That's more than 10 times our GDP.
Yes, it is. And what's also important, the deposits are at the moment even bigger. There's quite an excess of deposits in the economy, which actually reflects the slow and the low growth that we're experiencing at the moment. But that's a topic for another day. But I think when you look at the numbers, for me, there were three things that stood out. Number one, and that's very important, is that you can see how competitive the banking landscape is. Yeah, the big four and plus Investec trying to grow in South Africa as well are continuously trying to compete to try and gain market share from each other. And at the same time, you've got a lot of these smaller, newer players trying to come in. And maybe the second point there for listeners, it's always important to differentiate between what we call corporate and investment banking, and then let's call it business banking, the smaller corporate business, and then thirdly on the retail side, personal and retail banking. So Standard Bank dominate because of their very big large corporate and investment banking business, and for corporate investment banking to do well, you need mainly three things, and you need a lot of other things. But the most important is good management, which they've got. But number one, you need a big balance sheet, because when you deal with the big corporates, they want to do transactions, buying, selling, doing business in big scale, especially if we go into Africa or overseas with Hong Kong so you must have a big balance sheet, and almost size begets size. So the bigger you are, the more chance you have, as long as you keep giving good client service, of growing that. Standard Bank have that, and that's why they've done so well. But the second one, obviously, you need skills. You need bankers and people in your team who can put those transactions together for clients. And the most important to have that big balance sheet, you also need to have deposits. And so deposit gathering is often underestimated, the importance of it in banking. And for deposits, you need trust. You need trust in the franchise. So Standard Bank has done very well over the years, because it's just over those years, it's always been very stable, consistent, trustworthy, and that's why I think its client base, it's backed it. And it's got one other thing in its favor, although the other banks are catching up, and that's its big network in Africa. So if you're a large corporate and you want to do business, or you want to do a loan or a transaction, you export or import from Africa, then Standard Bank is the bank still with the best reach there. So maybe just on the third thing, and then I must allow you to ask questions. But so the competition at the moment from the newer entrants, Discovery, Bank Zero, Time Bank, also now African Bank coming back, that all happens more on the retail banking side. It's coming also on what we call SMEs, small and medium enterprises, where Bank Zero is trying to focus in on. But so those smaller retail-focused banks, they've got the advantage now that their technology is fresh and is younger, and it's more user-friendly. And it's interesting, in the 1990s, there was a lot of research done, and generally all the consulting firms and the banks believed that, and the numbers showed it, that 20% of your clients, your banking clients, generated 80% of your profit. Sure. 80% of your clients were actually unprofitable, and that's because they just didn't your technology was just too expensive. But that's actually changed. The technology is allowing the smaller banks to come in and attack the banks on the retail side. And that's really what's happening. The smaller banks are coming in. Bear in mind, maybe last statement, is that the smaller banks generally tend to initially start with 1 or 2 or 3 products. So that's a disadvantage because you can't offer a client a number of products. And the most important thing, that the fight is really about your transaction bank or your bank account in which your salary is paid. And so Time Bank shows excellent growth in numbers, but it's what we called clients of multi-banking. So they open just another account with Time, they get a card, they can place deposits there, but it's not their primary bank. And that's I think where the big fight in retail banking is going to be, is the fight for those primary banks, banking relationships where you can offer a number of products, but where the salary gets paid in. And for that, you need good systems, a good service. Okay, I've spoken enough.
Well, Kokkie, you've actually covered a lot of my questions, I think, as you were speaking. But then with this, case that you've presented to me, keen to get your thoughts on how Old Mutual Bank fits into all of this. Because, of course, we speak about the little guys, we speak about the big guys. Old Mutual is not a small company at all, and they could actually grow exponentially there. How do they fit into the greater scheme of things?
Yeah, a very good question, and I could regale the history of what we call bank insurance in the old days, where you had Fortis Bank and Insurance in Europe, ING. You actually had Citigroup and Travelers, the largest bank, largest insurer, then merging. The theory was always that banks needed insurers to sell insurance products to their banking clients through the branch networks. Old Mutual is trying to do the opposite thing. And it's interesting, Sanlam sold their stake in Absa that led to the Barclays transaction many, many years ago. Old Mutual sold their stake in Nedbank. So why now a bank? And I think it's mainly 2 reasons. Number one, insurers generate a lot of payouts. There's a lot of cash inside an insurer when a client gets a payout, whether it be short-term insurance, whether it be life insurance, whether it's a policy that matures. And so the thought is always in insurance that if you have your own bank, you can capture those deposits. You can, because your systems tells you Joe Soap is going to have his policy paid out on the 5th. You can send him a WhatsApp and say, we can offer you a very good rate. So that's number one. But obviously a bank, then you have got to offer transactions, you've got to offer products which either the client can save with or can use. And I think that's what Old Mutual is trying to capture, that in-house client base. So I think initially they'll just compete with the other banks just for clients that are Old Mutual clients on the insurance side. How successful they're going to be, again, to have this, remember what I said, that's a primary bank account that's important, the one in which your salary gets paid in. So, but it does increase the competition. I think they're going to find it's more expensive. It's to take clients away from other banks. You always get the clients who are unhappy because they're not getting the facility they want, which means it's a higher risk clients. New banks always take the higher risk clients, and I think that's going to be the challenge for Old Mutual.
Well, certainly an industry worth watching, Kokkie. An absolute pleasure having you with us today. Thank you so much. That was Kokkie Kooyman, he's banking analyst from Denker Capital.